So hello everyone, very excited to be here with some great managers dedicated to the space. I think I expect them to be quite diverse in terms of products that they offer to the market, so that will give us a lot of information about raising assets. So maybe we can start with intros, maybe a quick intro about yourself, your firm, and maybe give an indication of how, what kind of service you provide to that market so that it gives us a better opportunity to discuss raising assets.
Great, hello everyone. I'm Jeff Dorman. I'm the Chief Investment Officer at Arca, which is a Los Angeles-based asset management firm focused on digital assets and the ecosystem. We have two sides of our business. We have hedge fund and other private fund strategies where we are investing in the ecosystem. We also have another side of our business where we are creating regulated products using blockchain as the wrapper. And myself, I have a traditional finance background. I was an investment banker at Lehman Brothers, a trader at Merrill Lynch, a portfolio manager at Citadel and some other funds, and also ran a small fintech company called Harvest Exchange for around 5 years before getting into crypto.
Sharif-Askary. I head up sales and business development at Grayscale Investments. We are the world's largest digital currency asset manager. We manage a little over $2 billion through our 10 products. We give exposure to investors to digital currency in the form of a traditional investment vehicle, which is a titled security. In my role, I'm talking to accredited investors and institutions every day about how digital assets fit into their portfolios. Before Grayscale, I also worked for an investment bank for 10 years.
We're all recovering investment bankers. It's kind of funny. Andrew Keys, Digital Asset Risk Management Advisors, DARMA Capital. We have a quantitative systematic alpha generating fund that's a commodity pool operator and commodity trading advisor. We do single asset funds for tax efficiency for Web3 protocols. Prior to co-founding DARMA, I ran the capital markets team at Consensus, one of the largest software engineering shops in the world focused on the Ethereum ecosystem. And before that, I was an investment banker at UBS. And we domicile our fund in Puerto Rico for tax efficiencies.
Hi everyone, my name is Samani. I'm a co-founder and managing partner at Multicoin Capital. We're a thesis-driven investment firm focusing exclusively in crypto. We manage a hedge fund and a venture fund in the space. Both are fundamental-based investment strategies, long and short on the hedge fund, long only in the venture fund, managing 100 million and change. We have 13 people now based in Austin, Texas, and growing. My background, born and raised in Austin, programming since I was very young, built a tech startup before this, raised a venture, built it, raised venture, sold it, got into crypto in 2016 and launched Multicoin in 2017.
So very quickly about myself, I'm based out of Zurich, Switzerland. My background is in asset management as initially a trader in fixed income, then selecting hedge funds for institutional investors, CIO of a family office, and as of late, co-founder of L1 Digital, which is a crypto fund of funds based out of Switzerland. So why don't we start with the, you guys have been in the market or active in the space for a number of years. What are the challenges that you've faced during those years, and how have those changed in the last 2 years or so? Maybe we can start with you, Kai.
Sure. So when we got started in 2017, it was a period of euphoria. Obviously, people were generally just wanting to get exposure to the space. I think they wanted to learn from fund managers. I think the learning is still probably a key element that drives a lot of marginal investment, at least in a discretionary strategy like ours. And we're pretty well known for publishing theses both publicly and then sharing private thoughts with our LPs. So I think there's a lot of interest, still ongoing interest in learning. The euphoria part has obviously more or less died down. Things have gone over the last, call it 2 years, through the cycle of custody. That's totally solved the problem now. Folks like Coinbase and Anchorage and others have provided great solutions there. I think we're at the next kind of phase of the cycle where it's getting people on board with just understanding what are these things at large scale. Talking 10, 20, $30 million tickets from institutions are pretty rare still, but they're starting to be able to underwrite those internally, but still slow.
So I would agree with Kyle on education probably being the number one hurdle or area where we can help investors. I'd also add kind of defining personas for the investor. Not all investors are created equal, and a lot of our early limited partners have been very familiar with this space, so they're crypto native, if you will, and that persona may want to essentially acquire more of the underlying assets and may not be concerned as much with the volatility or absolute dollar return. Whereas if you go across that chasm into the institutional market, they're more focused on the absolute return. So basically defining the personas and creating products accordingly.
Certainly education, and I think also when you think about that, these are digital bearer assets. It's a new asset class, and it's not something that easily fits into the operational and legal framework for most investors, excuse me. And I think to an extent, the custodians, Grayscale, like for us, solved that problem. But at the same time, there's a lot of bureaucracy, and there's just a lot of processes at these firms. I will say that we are having conversations now with types of allocators that we would not have been able to have conversations with, call it 12, 18 months ago. So the conversation's definitely changing.
Yeah, I would echo that on the narrative changing a little bit as well. I think a year ago, 2 years ago, most investors would speak about why digital assets, right? Now it's much more how. So they're starting to get past the idea of whether or not I should do it, and now it's more about trying to figure out the best way to do that. And to Kyle's point, a lot of the infrastructure, that was a big problem a year ago, 2 years ago as well. Nobody understood what to do with custody or accounting or auditors. A lot of that has now been cleared up. Now, granted, some of these firms are new and maybe aren't battle tested yet, and maybe it takes longer for the due diligence of these service providers, but most of the real issues have been solved in that regard. So I think the two biggest sticking points right now, one, I'd echo the education, but I would go even deeper to say that it is combating some of the common narrative. I think the word cryptocurrency itself is probably the most damaging word in the entire industry, because it really makes everyone think in their heads, okay, there's 2,000 currencies trying to combat the yuan or the euro or the US dollar, and that's not really the case, right? There's so many different types of digital assets. So education is really about just not only teaching people new things, but also combating what they're hearing every day from the media or from other publications. And probably the biggest sticking point still is just a lack of investable product. This is still a tiny ecosystem, which means most of the big investors are too big to even invest in this space. Or they meet one or two managers, and those managers could not pass operational due diligence in any way, shape, or form because they've never done it before, right? So it's really about the group of people up here and others who are trying to build out that confidence and these strategies and these structures that the institutional investors feel comfortable investing in.
So I think you make a good point about, so education is continuous, right? I guess because the space is evolving, and we're not sure how it's going to evolve. The how is very interesting, and you pointed out service providers. Do you guys feel that that service providers who are new companies, do you think that they're ready to accommodate institutional investors? And someone made a point, and I'm sorry, I don't remember who, about the cost of the time it takes to due diligence those service providers, which is very, very important under an institutional setup. Do you think we're ready? How far are we? Because from our seat, I'm not sure we are.
So I think I was speaking with State Street and Bank of New York, and it was relatively public, so I don't feel bad talking about it. And they were talking about their kind of embarking on this journey and what their risk teams could handle. And first, fund administration is before custody, because then they don't have to technically have the assets. And I think that you're just getting kind of the years of the proofs of concepts and kind of dipping the toes in, and before you see kind of a widespread adoption from the usual suspects. But you've got kind of the old guard, but the new guards are the ones I think that are more technically beneficial to the asset bearers. There are new verbs, staking, voting, and creating the ability to do that seamlessly within the service providers, I think, is going to be a key differentiation.
So we've got So I think, for example, Kai and Ray are, you're covering very different products. One is very active, the other one is passive. How do you, and even Kyle, within the active space, you've got different implementations, right? You can do VC, you can do crypto only, etc. Where do you see the demand? And if you could essentially, if you could essentially break down the type of investors that would go into each of those kind of products, if we can talk about implementation and where the bottlenecks are.
Certainly, I think for us, we have a lot of our investors, I'd say, if you look at the last, the first half of the year, about 84% of our flow was from institutional investors, whether that's hedge funds, a lot of family offices and more traditional allocators. From our perspective, it makes sense to have a beta allocation and alpha allocation in the space. And we tell folks anywhere from 1 to 5% of an allocation to the space makes sense, and part of that's going to be active, part of that's going to be passive, part of that's going to be venture capital.
Yeah, so we generally recommend the 1 to 5, same range as Ray suggested. I think what we're seeing in kind of where we are in terms of target LPs is talking to a lot of endowments, foundations, a lot of traditional venture capital LPs. I think in most, given the digital assets still feel new, they kind of feel risky. In most institutions we speak to, the crypto person, if there is one, is typically from the venture team. We have not typically seen someone from the hedge fund teams in institutions kind of be the crypto person. There are some exceptions, but for the most part, it's the venture guy. And so we see kind of bucketed in the call it the high risk area, if you will. And that's how I think they are all thinking about it is, okay, if we're going to do this, we need to do it on a long time horizon. We need to commit to managers who are going to be around and in the space. We have seen, I've been surprised in our conversations with less interest in passive and more in active. I think they're concerned about underwriting things internally with the concern of a 70% drawdown, and no one wants to be the person who sponsored that investment. And so their kind of natural hope is that active can at least mitigate some of that. But I think there is some interest in beta. I'd say the most progressive institutions we've seen have said, hey, we want venture, long only, long short, and maybe some systematic. But I've only seen that level of, not that that's a particularly complicated view, but I've only seen, I think, 2 institutions say, look, we're targeting these 4 fund strategies. But they're starting to get there. I think over the next year, a lot of folks will say, okay, we need these buckets of strategies.
And I think that the sophistication, to Kyle's point, is definitely getting better. I'm not sure many of the traditional pensions or endowments are ready to necessarily look at 6 or 7 different sub-strategies within crypto and be able to immediately identify which one they necessarily want. And I think there's a reason that they have, for the most part, poured more money into venture-style funds than anything else, simply because they already have a mandated bucket for that, right? It's very easy to take an existing venture sleeve of the alternative bucket and just put it into a venture portfolio that's focused on crypto, because from their standpoint, really nothing is different, right? You're still investing in the equity of private companies. These companies just so happen to be in the digital asset space. It's a much harder mandate and a much harder process for them to get into digital assets themselves. And I think it's slowly happening, but it's unrealistic to think that it's going to happen quickly. I used to run very bread and butter, high yield credit funds, and it still took 18 to 24 months for due diligence. And that's when they already had a mandate that said they already knew exactly what they wanted. They had the data to support what they were doing. They still had to do a lot of due diligence to figure out the right managers and the right specific risk profiles and return profiles within that sub-strategy. So I think the work is being done. It's much further along than you can see with any sort of metrics. But it just takes some time. And the one caveat, though, I would say with regard to what the allocation is asset allocators are very good at determining what percentage of their risk should be in any one bucket when they have the data to run the numbers, right? So for me personally and my team, we don't feel as asset managers that it's our job to go tell them what percentage of your fund or your assets to go put into our fund. It's our job to educate, to help them understand the risk and reward and the profile that we're giving them and the data to support that, to allow them to make the decision themselves using the models that they're used to using. And the fact of the matter is, there's just not that many funds with that much data yet to allow the investors to do that. So, sometimes there's no real quick answer, it's just time.
Okay. So So you've got a potential investors on the fence, and you've got 3 arguments to give them to get into the space. And we'll start with a different strategy. So Andrew, what are your arguments to get them involved in the space?
So I think that we are literally witnessing the next generation of the internet and the birth of a digital commodity asset class. And I think those 2 compelling reasons make a lot of sense. And I think that understanding what the stack is, kind of a derivative off the FAT protocol thesis, where the application layer garnered the most value accrual, the Facebook, Amazon, Netflix, Googles of the world, in the legacy internet. And I do believe that the application layer will be thinning out and really defining kind of what those protocols are, whether it's storage of value and things like Bitcoin, smart contract layer, decentralized file storage, really explaining them what that process and what that landscape looks like.
I think when you take a step back, you have a new asset class that didn't exist 10 years ago. It reacts differently to the market forces than traditional assets like stocks and bonds. You have characteristics that render it a good store of value. You have characteristics that give you a technology upside. So I think understanding that the right allocation can provide diversification is important.
Yeah, for sure. I mean, for sure, the number one selling point right now is the uncorrelated nature of this asset class to everything else. You'd be surprised in these meetings, it's not the 22 or 25-year-old young person in the room who actually understands crypto who generally advocates for the space. It's usually the 50 or 60-year-old risk manager who's been through several cycles and understands what happens when all of your assets go down together or all of them go up together. I mean, last year alone, gold, bonds, and equities were all down, and this year they're all up. So they really understand that correlation narrative. But in terms of other things that are maybe less obvious that we speak to, that to really help people understand this space is less about crypto and more about the other things they own. We really challenge people to think about the status quo. I mean, how many people are invested in something that is affected by the repo markets right now and don't have any idea what just happened to the repo markets? They don't care. They assume the Fed's got it under control and they'll move on, right? Or thinking about even the valuations, right? We just saw WeWork go from a phantom $50 billion valuation to somewhere north of zero. And everyone talks about equities having intrinsic value. Well, what is intrinsic value, right? It's assets minus liabilities. That's your intrinsic value. But multiples, equity multiples are many, many, many times above that intrinsic value. So if you start just questioning what you actually own and the status quo of what you own, rather than thinking that something new is automatically wrong, think about what you own and if that's right? Maybe the 60-40 portfolio isn't right. Maybe the thinking that everything that used to be normal in this world is no longer normal because of all the monetary policy. And I think when you get people starting to question what they own, less so than trying to force something new on them, it really opens eyes. And then the third thing I think that we tell people all the time is go talk to someone much, much, much younger than you. My son is a good example. My son is 6. I brought him to Cleveland where I grew up, and I showed him my baseball card collection of hundreds of boxes of baseball cards, and he could not care less. Loves sports, loves baseball. Could not understand why I had a box of cards in a basement box. But I showed him a digital non-fungible token of a Trevor Bauer that I purchased for $30 worth of Ethereum, and he thought it was the coolest thing ever, and he's running around the neighborhood showing people this Trevor Bauer. So if you start to open your mind and think about what young people who aren't jaded by the traditional status quo, it really starts to make people ask better questions, and when you ask better questions, you usually get better answers.
Yeah, the thing I've observed is it's 100 times easier to underwrite crypto as an investment if you really truly believe in the kind of the core theses. And so for those who, if there's not someone there who really is bought into the kind of the core investment theses, I encourage them to try and understand the arguments from the bulls. We wrote an essay a few months ago trying to kind of articulate that at a pretty high level. We call them the crypto mega theses, that we try and present why this stuff is important on kind of a deeply fundamental level. Andrew talked about Web3 and Web3 protocols, and I think that's a huge opportunity. I think the other one that's probably more tangible to a lot of investors is what we'd like to call open finance. The idea that you can have a piece of code act as an escrow agent or act as a financial contract that is guaranteed to execute perfectly every single time without exception, like that is a breakthrough concept. Everyone in the world up until 2008 thought that you could rely on a lot of banks and other intermediaries to do that perfectly, and it turns out human institutions are fundamentally fallible, and you always have counterparty risk no matter where you park your money. For the first time ever with these systems, you actually have contracts that are rock solid, cryptographically and programmatically. And that is a really deep like concept and breakthrough. And if people can kind of grok and say, okay, that's interesting, what can you do with it? And then start to dive a little deeper, the light bulb starts to go off. And once the light bulb goes off, it gets much easier to underwrite any risk, any strategy in the space, whether it's discretionary, whether it's systematic, whether it's passive.
So I mean, obviously the fundamentals make a lot of sense, but so what I've experienced with institutional investors is that they're mostly focused on their portfolio. And Ray, you mentioned the correlation benefits of the asset class within a portfolio. But how about, I don't know if you've experienced this, but what is the value to those institutional investors of asymmetry in that, you can place, because it takes time to understand the thesis, the fundamentals, and you could be wrong. But if you're wrong, you can risk manage it with a certain position size that you can handle. Is that asymmetry something that is being sought by those investors, or?
Yeah, I mean, I think the digital asset space is basically venture investing for the most part, right? Most of the investments that we're making in this space are early stage companies or even early stage projects and protocols with no company behind them. So that is venture investing, which means, it does take time. It's going to take 3, 5, 7, sometimes 10 years before you see the value here. The difference, though, is because the digital assets themselves are liquid, you're adding a level of liquidity onto a venture-type risk profile that was never been there before. And in something that's this new and changes all the time, the ability or having the ability to change your mind is really important, right? You look at a lot of the passive indices that have been invented in the space, and they all have, 70, 80% of them are in tokens that nobody would touch anymore because the space moved faster than the indices can adjust. So I think having the ability to stay liquid while still offering that venture-like return profile is really important for investors. And once they get comfortable with the infrastructure and the digital assets themselves, I think it's a no-brainer for them to start to move some of the traditional venture money into more liquid strategies.
So you still have a lot of investors that are passing on the opportunity. I'd love to start with you, Ray. Why do you think, what are the main reasons for them to pass on that opportunity?
Absolutely. I think we a lot of it's interesting. A lot of investors that we meet are folks who are within their organization. Perhaps they're younger, perhaps they're not. And they personally have become invested in the space. They're evangelizing within their organization, but it's really hard to get the buy-in from everyone else, and especially if the firm is bureaucratic. So I think it just takes time. I mean, this asset class didn't exist 10 years ago. So, getting comfortable with something that's inherently new and very different than all the other things, and then finding a place for it. I think, again, within, as we were saying before, is it something that fits within the VC bucket? Are the VC folks looking at it? Is it something that the liquid alts folks are going to start looking at? Is it the hedge funds teams, excuse me? So I think fitting it in even within these institutions, figuring out where it fits in.
And I think there's also just some basic blocking and tackling. Striking NAV, custody. So we've tried to create a somewhat vanilla structure, kind of having Delaware came in, master feeder with the auditors by Big Four, and just having things that everyone's used to, because it's just a different asset class. So I think having that. And one thing that I talk about on the venture side, I'm a little bearish, I think, compared to the rest of the panelists on the notion of kind of the application layer. I think, we're extremely early, and I think that these things will get much more sophisticated. From 96 to 06, 85% of .coms went to zero, and we've seen a little bit of that. And with that said, we're kind of building applications for protocols that are not yet fully functional. So you still have the vision risk, product market fit risk, but you're also taking risk for if what they're building on top of roads that are not fully paved. And I don't think you have risk-adjusted return profiles that take that in. So I think that we have to think about kind of where the application layer fits in kind of a scale of time.
Yeah, I still think the biggest challenge for most people is just underwriting the risk of the asset class, because quite frankly, most people don't get it. How many times do people question kind of fundamentally what is money, and why like what it, and going through that conversation on Bitcoin and digital gold, that's not an intuitive conversation for most people. The stuff like open finance, although it's intellectually very interesting, the usage is still not there in meaningful enough volumes to attract people's attention. So I think a lot of people very rationally say, "Meh, I'll just wait and see until there's more proof." Of course, typically they wait too long and then they buy at a much higher price. It's kind of the classic dilemma. But it's one of those things that if you can get people to grok and say, "Look, contracts that execute programmatically, what can you do with this?" And yeah, maybe it's 1 year too early, maybe it's 4 years too early. It's always hard to time these things perfectly. But if you can see the kind of fundamental primitives, see the excitement, see the range of smart people in the space. I mean, we have partners leaving Sequoia, right? Andreessen spinning out funds, partners leaving Lightspeed. Like, there's a lot of super, super smart people quitting very, very high profile institutions to go in this space full time. There's something there. And so getting people to say, "You know what, we're going to be exposed because when this thing goes, we're going to be too late to catch it, so let's get in there now." But most people, I still don't think, have been able to kind of fully underwrite that.
And I think with kind of the digitization of money, there's a regulatory clarity aspect. I think that's one huge part where with these amazing decentralized finance, open finance applications, we still don't have regulatory clarity on things like KYC and AML, which I think FinCEN is probably the biggest elephant in the room with respect to really understanding the application layer.
So why don't we talk about capacity for a second? So we've been talking about institutions coming in, and it's raising asset panel. So we'd love to raise more assets, obviously. But how much, considering the volumes, the assets that are traded, the talent that is present in the space and that's relevant for active managers, how much can we handle in volume, in your view, without compromising returns?
So for us, we have 100 million specifically in the Ether fund and about 20 million in our Bitcoin fund. With prices as is, we probably couldn't handle much more on the Ether fund. Bitcoin, we could go up to about 500 million. And basically, the main issue is liquidity providers and slippage, because we're trading in and out of these G7 currencies.
Yeah, I mean, I think every strategy is obviously very different depending on what it's doing and what the risk characteristics are. But for our liquid, actively managed, event-driven fund, we think very easily up to $200 million. We wouldn't have to change our strategy at all. And that'll obviously grow as the size of the entire asset class grows.
Yeah, I think we're uniquely positioned given our track record and our scale and the fact that it is a passive strategy. Not right now given the sell-off, but our Bitcoin fund is close to $2 billion. So I think there's certainly room.
Yeah, so in our hedge fund strategy is liquid discretionary. That strategy, we pretty straightforward liquidity thresholds. We don't want to be more than 5% of daily volume. We don't want to be more than 20 days to enter or exit a position. And we measure that on exchanges that we will trade on. There's quite a few that we won't. So we've kind of looked at our portfolio historically, our concentration targets and everything else. And depending on which point in time you look at over the last 24 months, we've been able to support as low as 150 million, as high as 300 or 400 million. So kind of in that range for our liquid strategy. On the venture side, we're actually raising a venture fund now, and we're thinking about this. And I'm pretty sure you can deploy 200 to 400 into a venture strategy over a 3 to 5 year period. That's very doable. So the market's growing. The rate of opportunities is accelerating. As all of these layer ones and all these new protocols hit that have not been liquid traditionally, the investable universe will grow. So I think there's quite a bit of upside in a lot of these numbers from all the panelists that we should reasonably expect over the next 36 months.
And how do you see capacity dynamically increasing? I mean, what metrics would you look at apart from, so you mentioned one, which you're going to have new protocols coming out. Is proof of stake going to help with that in attracting more players into the space and bringing more volume and more capacity. I'm just wondering, how do you think about capacity going forward? How could it evolve and where could we get to?
Yeah, I think the biggest thing that can happen is just more derivatives. So, the biggest derivatives exchange traditionally in crypto has been BitMEX. Binance just rolled out derivatives like a week or two ago. Volumes are looking very strong. I think they did 700 million on Tuesday in Bitcoin futures. Ether futures are coming. BitMEX has Ether today. I think we can, as the space matures, we'll see futures for more and more assets, and futures bring in just a tremendous amount more liquidity than just the spot. And so that will help a lot, especially for systematic strategies. That, and then just adding new protocols and just general interest and exposure and more usage of these things will bring liquidity all around.
Yeah, each protocol can have its own distinct ecosystem fund and easily spend $500 million per protocol.
I think it's actually just the growth of investable products that we're investing in, meaning like there's an exchange out in Asia called Bitfinex who got into some trouble from a cash flow standpoint and overnight issued $1 billion worth of tokens. You're just going to see more and more things like that. You're going to see private placements that are tokenized. You're going to see public companies eventually figuring out ways to wedge a token within the cap structure of debt and equity, right? Maybe it's some sort of loyalty reward program. Maybe it's some sort of additional revenue line item that has certain perks. So I just think the amount of things that we're able to invest in are going to grow just as much as the existing ones are going to grow, and that's going to make it much easier to have higher capacity funds, which will in turn bring in the larger investors who right now are somewhat capacity constrained. So it's all sort of feeds on itself, and I think it becomes sort of exponential in terms of the growth of this industry.
So I suggest we open up for Q&A to the audience, if anyone has any questions.
How many allocators are here?
I'm not an allocator, I have a question.
So there were 0 allocators here. I think that's an interesting.
Question. You mentioned the slippage earlier when looking at executing your trading strategies. I run a market data provider, and we recently created an endpoint for slippage across all markets. How do you currently do that? Do you have your own infrastructure in-house?
Yes, we have an internal algorithmic trading team. But I'd be happy to take it offline with you. So I think one interesting is we're all kind of proponents of the industry, and I think it's interesting that there are, when asking if there are any allocators here, we're all probably talking to our own echo chamber, and I think that that's kind of one of the interesting issues here and kind of crossing those chasms. And I think that that's something that we as an industry really have to work on.
So how do we, I know that, I know Kyle more than anyone, but I know that Kyle organizes every 6 months an event for education. I think those are ways to do it, but how do we resolve that issue?
I think, again, education is the name of the game, and we do a lot of family office education. We work with a few family office service providers that manage about 2,000 families throughout the world. And basically, we've got webinars and in-person meetings, and basically explaining what the stack is. Teasing out what is money, and I think the more we educate, the better we'll be.
First of all, I don't believe there's no asset allocators here. Asset allocators are trained not to raise their hand at that question because then they get bum rushed at the door. So I think there are asset allocators here. I know many of them are here, but also, again, the education stuff. At Arca, for instance, we do a weekly market recap that compares what happened in crypto to other asset classes. We do monthly investor letters. We do monthly webinars, sometimes on the macro front, sometimes specific to our funds. We do, every 6 months, we do a family office event to educate, bringing funds and other people from the ecosystem to just speak about the digital asset space. We have a podcast that where we interview companies and protocols and projects in this space to try to educate. And the nice thing is we don't have to guess. We have analytics. We can see it. We get sometimes 85% open rates on some of the stuff we put out, and our distribution list has grown from nothing 2 years ago to 15 to 20,000 people now. So you can see it, right? Just because they're not raising their hands, just because maybe they don't show up for a conference. The allocators all absorb and learn in different ways, and they're all bombarded by information. but you can see that they care. They're educating themselves, their questions are getting better, and again, the open rates don't lie. You know that people are paying attention to this space, even if they're not putting the money into it yet.
I would agree with that. We see very similar dynamics, and I think it's important to create content that fits within the way we think about traditional investment products and through the lens of how we think about traditional investing. So for instance, we have a pretty extensive body of research on our website, and we certainly have all manner of allocators that are consistently looking at those materials, asking us questions.
So I fully agree that the interest is there. Everyone wants to learn about it, but the difficult part is pulling the trigger and investing, and that has to do with that dynamic of career risk. Do you think, well, at least I can talk about Switzerland, but do you think that we've passed that in the US?
I think we have, but it's still slow. I mean, it's public information that Yale has invested. It's public information that a lot of the venture funds have spun out kind of separate entities and vehicles. And so that makes it easier to underwrite. And those were probably likely to be a lot of the first underwritable funds, dedicated funds for a lot of traditional LPs. Once Yale, at some point is going to come out and say, oh, we invested a year ago and we're up, whatever, 100% or whatever the number is, right? That then forces every investment committee around the country to go through this process and say, oh, why aren't we in? Libra over the next 12 months is going to force investment committees around the country to say, what is this thing? Why does it matter? China, PBOC is working on digital bank cryptocurrency. The day that they formalize the plans and announce, concretely how this is going to work, Steve Mnuchin has to go on TV and respond, right? And when these things happen, it just forces every investment committee in the country to think about these questions, and inevitably some of that capital is going to pour into the space. So timing all of those things again is nearly impossible, but it's the catalyst you can see kind of fundamentally over the next few years is crystal clear. And so that's exciting. That's going to help push people over the edge.
It's also been a 10-year bull market in equities and a 30-year bull market in fixed income. So, even if you're on the fence, there's nothing pushing you over that fence right now. At some point, that's going to snap, or at least, the GMOs of the world who are talking about what the next 10 year of returns are going to look like. At some point, that forces people's hands into something else. You've already seen it in the venture space. That's why we have incredibly lofty private equity valuations. You're seeing it obviously in real estate, although down in Miami and New York, that's starting to unwind a little bit. But, asset classes do change, allocations do change. You just need that push. And I don't know what that push is going to be, but it will happen. It always does.
Okay, I think we're up. Well, thank you very much for all those insights. Keep on performing to get those institutions and investors in. Thanks a lot, and thank you so much.
Thank you.
Thanks, Ray.